Welcome to the Pot of Gold podcast, where we talk about finances, wealth generation, and real estate investing. Today on the show, we have Gina Weibel, who is living in Washington State, and she's been doing some capital raising for different funds and syndications. And we're just going to get an idea of what her story is like and what it could be for, like if you're interested in funds and syndications or investing and such, what that kind of process looks like. And well, I just want to say thanks for coming on the show today, Gina.
Yeah, thanks for having me, Nathanael.
Oh, definitely glad to have you here. And I was just kind of hoping that you could give us a little bit more about your backstory. How did you get started into doing what you're doing with real estate investing? And where are you at right now?
Absolutely. I am one of those stories of somebody who was not at all in real estate investing. I had zero experience, zero exposure. I ran a couple of small service businesses for 20 or more years. And then, and I was married, and my spouse was zero interested in anything related to real estate in any form. And then during COVID, as happens to so many people, we got divorced. And for the first time in my life, I could make my own decisions. And so about less than 18 months ago, I joined a mentorship to help me learn about real estate because I had always had a draw to it. And also, I found myself in a position where I need to take care of a family, and I have an advanced degree from an Ivy League school, but I haven't used it for so many years. And I did have friends who were willing to help me get into an entry-level engineering job. But I was like, man, at my age, starting entry level is kind of a stab, and it's going to take 10 years to actually get to a decent place. And I want to retire by then. So I really feel like real estate is my opportunity where if I put in the effort and I get involved and do things right, I can make money, and it's not determined by climbing a ladder and slowly working my way up. And I can still work from home. I still have kids in school. So yeah, it was a good fit for me. So I've been doing that for about 18 months. I've been full-time real estate investing. I joined this first mentorship, and they really focused on wholesaling, fix and flipping, and it didn't really feel like it was my jam. But I was happy to meet a bunch of people and happy to make a lot of connections. And then in January of this year, I joined Gator. So that was 11 months ago. And I had already done a couple of private money lending opportunities, but I started doing more of them. And I went to Squat Up Summit and decided to join the Sub 2 community as well. And I also did another mentorship in multifamily, which wasn't that helpful. I've done a lot of mentorships. I'm starting to get more discerning about them. They're not all helpful. But I have participated in 4 multifamily projects, and I'm also part of a team now that we purchase homes sub 2 and sell with fractional ownership. And in my multifamily projects and in this sub 2 project, I raise capital to help find people who want to get that type of return and help them find the right investment that fits their needs. And I put my own money in too. So in both private money lending and in capital raising, the underlying skill is also underwriting, because I have to choose which people to work with and which deals to bother lending on or participating in. So I'm still increasing my underwriting skill, but I feel like that's maybe the secret quiet skill that you have to be successful in anything.
Now, you mentioned fractional ownership. Could you go over that a little bit? I'm not familiar with the term.
Yeah. Do you want me to talk about this deal, or is it too early for that?
It's completely fine.
Okay.
We'll just kind of take this where it goes, and I'll make sure we ask the questions that we are curious about.
Sure. And so this is a project where we are looking for more capital partners. But my partners and I buy houses subject to, and we're focused only in the state of Florida right now. Then we turn around and sell them. Normally, if you sold the house on a wrap, which I think most people are familiar with, the deed would be held by the end buyer. And we would become the bank, we would be seller financing, and then that end buyer would be paying us a mortgage, which, since we sell it at a higher price and since the interest rate is at a higher interest rate, there will be a gap between what they pay us and what we pay the original
Yeah,
sub
it's kind
to.
of an
And
interest
that's our cash flow.
arbitrage, right?
Right. So a wrap seems nice, but it has a few problems. Like if the end buyer defaults, it's a real hassle to get the deed back. And if you end up sending it to foreclosure, it could wipe out the whole subject to mortgage and everything. Also, if the end buyer decides that he wants to sell out really early after just a year or two, and he sells it, again, that wipes you out and wipes out the sub two. And you're like, man, that was a fantastic 2% mortgage. I didn't want it to end after 2 years. I wanted it to last for,
Yeah,
30
bringing
years.
in that
Right.
like you said,
So,
interest.
fractional ownership is where we keep the deed in the LLC of our company, and we are selling the end buyer shares of our company. So when he makes a 10% down payment, he's purchasing 10% of the LLC. This is great for a couple of reasons. When he decides to sell the house in 5 years, by then the house has appreciated, so it's worth more. And he gets to realize the appreciation on his 10%. By now it's probably 25%. But we also get to enjoy appreciation on our 75%. And also, every year along the way, we can take depreciation on our percentage, whatever it is that year, and he gets to take depreciation on his percentage, whatever it is that year. Whereas in a wrap, there's no appreciation or depreciation. You're just a bank. So
Okay.
this is like the good parts of the wrap, but also the good parts of owning a long-term rental. Like, how
Yeah,
can
so
I
you
take
also
both the good
get tax
parts?
benefits.
Yeah, but
Yeah.
the bad part of owning a rental is having to fix the toilets. But in the operating agreement of the LLC, it says that our end buyer, he's responsible for the insurance and the taxes and the care of the home, but he's also gets to make all the decisions about if he wants to improve it. Or, I mean, he's a homeowner, so he gets to decide what to do with the house, and he gets to decide if it's time to sell. So that's up to him. So one thing that happens when he sells also, if it's been 10 years and he decides that he wants to sell now, he can't just go out and sell it without us being a little bit involved, because we still own some percentage. Maybe it's 50-50, or it's probably a little less than that at 10 years. I mean, he hasn't earned quite that much. So let's say it's 25-75. He wants to sell his 25%. We all meet, everyone in the LLC, and we talk about it. We're like, what are the market rates? What are the insurance rates? What's the value of his 25%? And we can offer to purchase from him his 25% shares, buy them back, and then get a new end buyer and start over if we really want to keep the sub two going longer. Or if we look at the price and the value of the house and we realize, you know what, we've earned so much money on appreciation, this is going to be great, let's sell it on the market, we can do that. So there's an option to keep the sub two going longer. And we'll decide whether or not to exercise that. And we would still give the end buyer what's rightly his. It would be a negotiation, and we would, we're not trying to cut him short or anything like that. So it's a way to solve some of the problems that come up with wrap buyers, the
Got
end
it.
buyers. The end
Okay.
buyers can sometimes be problematic. Also, if he defaults at some point in the operating agreement, it says if these payments stop, you lose your shares in the company and you lose the provision that gives you full control of the property. So we evict him, or maybe he's already taken off, and we take over the house and we get back all the shares. And that's much easier than having to deal with foreclosing, and if someone had the deed.
So question about that. The 25%, let's say, that's his share. Does that mean he only takes responsibility for 25% of the monthly payment? Is that how that works? Or
His mortgage, if you're making a mortgage to US Bank,
Uh-huh.
Every month you have to pay US Bank $1,000. And in years 1 through 5, most of that $1,000 is just paying interest.
Yep.
But in year 30, most of that $1,000 is paying principal. We have a similar amortization schedule for our end buyer. So it's all laid out in all of our paperwork. As he makes his payment, it's always the same payment every month, and he's paying to slowly buy more shares of the company. But at the beginning, most of his payment is just interest on, he does have a mortgage with us.
Okay.
And it's written out, the mortgage is being paid to these people. So in terms of that payment, he pays all of that. We are responsible for paying the sub 2 payment, but the end buyer doesn't need to know about that. He's not involved in the sub 2 payment. He doesn't know where we got our money or what we're doing with our money. He's responsible for the taxes and insurance, if you were asking about that.
Yeah, for escrow and stuff.
Right.
Yes. Okay. Interesting. No, it's a very interesting structure. I like how creative it is. It's definitely different than I would have assumed. When you said fractional ownership, the first thing that came to my mind was something like timeshare. And so,
So there is also, we didn't invent fractional ownership.
mhm.
There are companies out there who advertise similar to us. So for us, we're saying, would you, Nathaniel, love to own a long-term rental? So that, because you want passive income, but maybe you don't have 100,000 or 200,000 to buy a long-term rental. You can come join us as a capital partner, and you will also be in the LLC, and you will be on the general partner side, you'll be the capital partner, which is like being a limited partner. But in our LLC, you'll be one of the members in addition to Joe and in addition to me. We are going to give you 100% of the cash flow until whatever point your profits match your original investment. It doesn't mean that your original investment is gone. It's not. It's still tied up in equity. But for up until you match whatever amount you put in, let's say it was $50,000, we're going to give you all of the cash flow. That may take several years. That might be the end of the deal. But if it goes on beyond that, then the cash flow we're going to divide, you still get 60%. And then finally, I get 40% because I found the deal, structured the deal, found the end buyer, all those things. We are going to give you 50% of the equity, and I'll keep 50% of the equity. And when we sell the property, both of our equity will have grown in value, and we will both cash out. So we structured this with numbers so that this is as good or better than if you were to buy a long-term rental that meets the 1% rule.
Okay.
And we structured it to also be as good as if you invested in multifamily, which I also do a lot of multifamily. And one reason that people sometimes don't get to invest in multifamily is because those entry levels are often high, maybe $100,000. And oftentimes, if it's structured in a way that only accredited investors can participate, my friends are never even getting invited to participate.
Exactly.
So
Well,
this
let's touch that real
project,
quick.
okay.
For our listeners, what's the difference between an accredited investor and a non-accredited investor?
So accredited is if your net worth is $1 million, or if your income is, gosh, I should check and make sure if it's still the same. I think it's 200,000 if you're single, or 300,000 if you come with a partner.
And that's separate from your primary residence, right?
Your net worth cannot include your primary residence.
Okay.
If you are accredited, you can ask your accountant for a letter showing that you are accredited. The SEC is protecting people who are investing from being taken advantage of or putting themselves in too much risk. If you have $1 million, they kind of feel like, okay, you understand what money is and how it works, and you understand how investments work, and you can be trusted to make decisions about how to invest your money. We're not going to babysit you. But if you only have $40,000 or $50,000 in savings total, and that's all the money you have in the world, I will agree you should not be putting it in a multifamily investment. You like need that for more short-term possible rainy day funds and things like that. So the SEC is protecting those people from having someone come along and say, invest your only $50,000 with us. You won't be able to get it back for 10 years, no matter how badly you need it, because
Yeah.
it's tied up. So not 10 years. Most multifamily deals are only 5.
Like 3 to 5, right?
Yeah, that's the most common number. I am in a few that are longer, because I am in a few where we are rehabbing and refinancing really quickly in the front end and giving investors back their funds in year 1 or 2. And then we all keep our equity and just hold it and let cash flow for 10 years or more.
Okay, interesting. Well, so kind of what I'm getting here is that the fractional ownership is kind of an option for people who might be in that bucket where they have only $50,000 to $60,000, and
Right,
maybe they want to put down 10,000, 20,000 to try to get a return on it.
right. Again, when I counsel my friends, I say to them, think about what your investing goals are, because for myself personally, I have some specified amount of money that is higher risk and higher return, and I do second lien investing with that, PML. And then I have some money that I want it to be a little safer, but I still want to keep it not tied up for too long, because I'm looking at buying businesses and I'm looking at different projects, and I need to know that my money's coming back pretty soon. So I do some first lien investing for short periods. And then I have some money that I'm like, as long as it's earning a good return, it's okay if it goes out for several years at a time. And that's my long-term bucket.
Okay.
So people need to sit down and think about what their strategy is going to be. And I don't want someone to feel sorry. Like if they put their money into a long-term investment, yes, it will be earning decent returns for a long time, but you can't change your mind. I just don't want people to regret afterwards.
Very similar to like say what a certificate of deposit. It becomes a liquid when it's inside
Yeah,
the CD, right?
but a CD is not usually 5 years
Yeah.
long.
Yeah. Well,
But yeah, it's
and
like it, and in this model with the fractional ownership, we could sell your shares. It would be a hassle and it might be a challenge, but we can find someone. We could sell your shares if you really wanted to get out. But I try to tell people, just consider that it's like buying a property. It's going to be kind of tied up. If you're thinking about buying a long-term rental, then it would be appropriate to also think about this. If you're not in a place to think about buying a long-term rental, then don't think about this. You want to buy a long-term rental, but you don't have $100,000 perhaps, or 200 or whatever. So,
well, I think this is all really good information, especially for people who are maybe looking to just get started. I'm kind of curious though, as you've started this journey over the last 18 months, have you run into any major problems that you had to kind of find creative solutions for, or any kind of hiccups that you may have run into?
I have had plenty of hiccups, and it's always because I didn't underwrite well enough on my private money lending. So I get better every time, and I learn little things that I'm like, oh, next time I won't do that. And so far, knock on wood, so far I haven't totally lost money, but I've had several projects where it was harder to get back, or a little bit scary, or things like that. Or it took a lot longer. And usually the problem was, if I could go back in time, I'd be like, oh, I shouldn't have lent that way or lent that much. The biggest problem ever is if you give people too much money too quick.
Okay.
That's my number one mistake. I had a couple of loans that I gave them the purchase price and the rehab all at once, and they did the project beautifully and paid me off. And I was like, that was so easy. That was so great. Let's just do that. So I did it again with someone, and the project took a different direction, not because the person was bad, but just because the project took a different direction. And they ended up not doing any rehab, but now how am I going to get my rehab money back? And they're overdue, and we're trying to get them refinanced to give me back my money. And it will happen, but they're late, and they've had rehab money and purchase price for 8 months on a 6 months loan. And I'm like, it puts me in a very tight spot, because I realize if I foreclose, there's no way I can get that rehab money back.
Oh, okay.
So I don't want to foreclose. I would have to sue them as well to get the rehab money back. And I did never expect that they would do zero rehab, but that it wasn't, they were not being malicious. It's just things went crazy with that project.
Life happens sometimes, right?
Right. And I have another project again where similar story. I gave more value than I should have. So carefully finding out what the as is value is and making sure that they never have more in their pocket than what you could get back from the as is value. And then absolutely doing draws. I'm happy to lend the repair budget, but I have to make sure that you start the repairs and then I'll reimburse you, so that the value of the property at any given time covers whatever amount of money I've given you. And I broke that rule a couple times, and it burned me a couple times. But then also a couple times it was fine. So I'm not going to risk that anymore. I'm going to be more careful.
Well, let's say no one teaches better than the School of Hard Knocks.
Oh, don't you know it? So you see I have a broken arm right now. I feel like I showed up at the skating rink and my freestyle friends were there, and I was so excited, and the emotion was high and the energy was high and the vibe was vibing. And so I didn't warm up at all. I just put my skates on and I went my fastest speed, and I was like, I'm going to just do some tricks. First time around the rink, who cares? I'll throw some tricks right now. And I fell down immediately and broke my arm immediately. I just arrived and I broke my arm immediately. And I feel like it was a summary of this year being drilled into me in a very tight way, which is go through the procedure. Don't skip any steps. Make smart choices and put safety instruments in place, like all the proper agreements, all the proper forms, and using the transaction coordinators that are in the right education. Do you want to hear a quick transaction coordinator story?
Oh yeah, sure. Tell us the story.
There was one project that was brought to me by a connector. This year I also tried out using connectors, and some connectors are still good, but there's a lot of connectors, way too many, that are excited to get paid, and they aren't any better at underwriting than I am. And I had really hoped that, I was like, someone's got the magic bullet where they're only going to bring me deals that they underwrote that are amazing deals. Nope. Never trust anyone as much as you trust yourself. So I can still use connectors, but I then have to, part of the warm up of skating and part of the warm up of private money lending is, it doesn't matter who brought you the deal. It has to go through my underwriting before I decide to lend on it. But this person was having me loan on a novation, which is where the buyer knows that his house could be worth a lot more if he could just do $40,000 in repairs. It'll be worth like 100,000 more. So he knows that he wants to do that, but he doesn't have the contacts or the money or the knowledge to do the repairs. Let me silence this phone. How do I make it stop ringing? Okay. The good news is I have a lot of deals. Okay. So the novation. So there was a guy, we'll call him Nate, Novation Nate, who wanted to do the repairs, and then together he and the house seller would split the additional proceeds that were earned from the fact that Nate had done the repairs. And the proceeds would be split after Nate gets paid back for doing his repairs. So they wanted me to loan the repair money. And I was like, that sounds possible. Let's talk about it. Nate had his own TC. We'll call him Terry. I'm using whatever letter goes with the thing.
Yeah.
And Terry was rushing and he was pushing me, and he's like, okay, here's a promissory note. okay, wire the money to the title company. And I'm like, Terry, why did you write the promissory note? You're a TC. I don't know anything about you. And also, I think you did a bad job. And also, we discussed that I was getting paid like a 20% flat fee, and you wrote it in as a 20% annualized rate.
Yeah,
Those are
APR.
different, Terry. How come you don't know the difference? And also, I was like, Terry, why did you give me a promissory note when we've never even filled out a JV agreement yet? And Terry's like, fine, here's a JV agreement. And I wrote him a long letter. I'm like, these are all the things that need to be in the JV agreement, blah, 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 blah. So he sent me back a JV agreement that was blank. It was one of the forms of a JV agreement we've all seen. Nothing was filled in. And then at the very end, it said addendum, and he just pasted the paragraph that I had emailed him. And I was like, Terry, you're the worst TC I've ever seen. So I told the connector, I said, I can't even move forward at all on this deal unless you use my trusted TC. So we got my trust, he agreed. So Nate agreed to pay my trusted TC. So the first day, the trusted TC, she's like, okay, let me look at this deal. I'll help you out. And she goes, okay, problem number one, you're putting a lien on seller Sam's house, but you're giving the money to Novation Nate. And she's like, you can't punish Sam. He doesn't have your money. That
If
doesn't
Nate
make any
doesn't
sense.
perform.
And Nate's like, just do it anyway. And I'm like, of course you'd say that, Nate. Where's your risk? You're not putting anything up. And my TC was the one who was like, this looks weird. And then I was like, why didn't my connector think that was weird? Like my connector apparently had been looking at this for a while, but he didn't catch that. And then, so I'm like, we need to figure out some other thing. The next day, my TC came back and she's like, I did a little more digging and I realized that Sam doesn't own this house. And I'm like, connector and also Nate, what the heck is going on? And then the next day we came back and the TC said, okay, I did just a little bit more digging and I realized there's an open HELOC with all these extra funds that have been taken out from the actual owner, not Sam, and it's still open. And I'm like, oh my gosh, what's going on, Nate? What's going on, TC? And then the next day she came back. I'm like, oh my gosh, this TC is worth gold. And she's like, I also found out that the actual owner is dead.
Oh, wow.
Sam doesn't own the house, and it's going to be quite a process for him to get it. It's one of his relatives, but it's like there's a lot that needs to go on to clean this up. And we still haven't had Nate figure out how he's going to secure my loan. And I was like, you guys, I'm just not involved. I'm not going to do this anymore. But if I hadn't got my TC involved, that first TC was like, okay, go ahead and wire. He was
Yeah.
ready for me to wire that day. Hire your own TC who's working for you, who's checking your back and making sure the paper is good for you. Because that other TC didn't care a whit about me. But my TC, she went to work and found more problems than the ones I've even listed. But like there was one part where they were like, we can have this document that states that nobody can take out any more money on the HELOC, but it was a whole ordeal. There was just so much stuff. So I felt really loyal to my TC. I made sure she still got paid, but then I never did that deal.
Gotcha. No, it's a good thing to have a second pair of eyes on anything that you're doing.
I know. And I learned a lot and I was like, okay, now I know that when I underwrite, these are all steps that I need to go through and be a little bit more digging. But it's super helpful to have someone in my corner who's going to do that. Because I'm like, do I have time to go do the title search and stuff? And I'm like, guess what? Happy to pay you $1,000 if you'll go do it. And if you'll go poke around for me. And she did. And actually, I've had other deals where I paid her to do that. And then I ended up not doing the deal because there was a problem with the title. So worth it.
Yeah, better to pay a little bit ahead of time to be able to avoid a setback, right?
Yes, for sure.
All right. Well,
There's a few things that I've learned hard ways.
yeah. Well,
I have
that's
another story.
definitely important. Like we said, the School of Hard Knocks is where you're going to learn a lot of your information and how to do things.
Right. I guess during your first year, you do the best you can and you try to learn from other people's mistakes. That's even better than learning from your own.
Oh,
So
definitely.
hopefully people listening to this podcast will learn from mine instead of their own. And people had told me to do draws, but I was like, well, I did it with Amy and she paid me back just fine. But not everybody's as good as Amy, so don't trust them. So,
well, definitely thank you for sharing that story and some of the things that you learned. I'm curious about what you're doing with the fundraising for syndications and funds, as well as what
Oh,
the differences are between the two of them. What's the difference between a syndication and a fund?
nice. So syndication is usually tied to one project. For example, I have a deal that I'm raising on in Utah, and we secured the deal, we got it under contract, we did our due diligence, we've got all the details about the deal, and now I am going and talking to my friends and showing them all the details, and I can show them what the projected returns are going to be for this deal and what our plans are, what repairs we plan to do, every detail about it, where it's located. They can even drive by it if they want. They can even go tour it if they want. So when people invest in this syndication, they know, they have a lot of information about what we're planning to do.
Mm-hmm.
When you do a fund, you're taking in the money, and the group of people managing the fund have the power to go choose what to buy, when to buy it, when to sell it, to buy something new, and it just kind of keeps moving. So when you invest in a fund, they'll tell you, we invest in the Salt Lake City Clearfield area, and we're looking for value add properties that are B plus or C plus that we can raise up to a higher level. Our hold time is always targeted to be around 5 years. We target projects that will give you a rate of return of internal rate of return of 19 to 22%. And they give you kind of what they're looking for, but they don't have the exact project to show you.
Gotcha.
But they have a good track record. I wouldn't go with a fund necessarily with someone who's never done anything. But if they're like, look, we've done several syndications and now we're going to have a fund, and our fund is going to invest in this type of thing, and you're going to get this type of return. And when it sells, we can take our money and go put it into the next type of thing. And you don't necessarily know what it's going to be before it happens, but they'll keep you updated. They'll still give you reports of, here's what we have, here's what we bought, here's what's going on. You just have a little less choice in the thing. For example, the Easy Dwell project that I told you about, where we buy the homes sub 2 and we sell with the fractional ownership. For the first 10 houses that we did, there was one house and we needed one capital partner, or usually was ourselves, to pay the entry fee to secure the house, which is usually between $50,000 and $70,000, which covers things like the arrears on the mortgage of that first mortgage, advertising, holding costs, cleaning up the house. So we're like, we need $50,000 to secure this sub 2 on this $300,000 home. After doing about, I don't know, 7 or 8 or so, we're like, we need capital partners. So then we had capital partners come in, and we would partner one person with one house, and they would bring the 50,000 and help us get that house. Now we're picking up where we're getting more traction, and we've got 5 houses all during the month of December 2024. I don't know when people are going to watch this.
Yeah.
It will change. 5 houses, and so we're putting these 5 houses into a portfolio. And instead of just pairing up one person per one house, we're saying this is a portfolio, and we need to raise $350,000 to get all 5 houses. Anybody who wants to invest can come be part of it. And it's not a syndication and it's not a fund, it's just an LLC. And we're going to have all these partners in the LLC. So we could, instead of having 5 people, we could have 6 or 7 or 8 or 10. We don't want it to be a huge number, but probably by this time next year, we're going to keep doing 5 in a portfolio every month. But by the time we get to this time next year, we'll probably switch to a fund model.
Mm-hmm.
And we'll say, instead of attaching you specifically to that portfolio of 5 houses, we can diversify your risk by just put money into our fund, and we will always be paying out people in our fund at a certain monthly distribution rate based on this big portfolio.
Gotcha.
And we're going to keep adding to the portfolio, and it's going to keep going. So the fund is where we plan to go. And I'm not a very expert on funds. It's part of our goal of 2025 with the homes is to get 100 properties in 2025. So right now we're at 15. So we need 85 more properties in 2025. And then we'll probably expand to a fund model, and we'll probably expand into another state. But we want to get really good where we are first. So a fund can help you pay for anything. And then another thing is that individuals like myself, at some point, someday, I could create a fund and I could tell my participants, I invest in multifamily deals that meet these requirements. Put your money into my fund, and then I will go find us the deals, and I will enter and exit as appropriate, just to make sure that our money keeps making money. And after you've seen that my first 10 other syndications and deals have succeeded, they'll be like, yeah, I like the way she works. I like the way she underwrites. I like the way she chooses deals. I will put my money in her fund. So there are plenty of people that have a fund where it's just one small team who's managing the fund, and then they are choosing where to put their money. So.
Okay. If someone wanted to put money as an investor into a fund, but not be an operator, what does that process look like? And what are the kind of the rules behind everything?
I know for syndications, when you're selling shares into a syndication, you are selling a security, similar as if you were selling a stock. So we are regulated by the SEC, and funds are too. There are different regulations. For example, there's super common one, which is 506B, and then there's a super common one, which is 506C. And I always think C for accredited. See, so if it's a 506C, some of the rules are people have to be accredited, but you are allowed to publicly advertise. We can make Facebook commercials and just throw it out there and target high income earners and show them the commercials about this and advertise anywhere we want. I can post on my Facebook and just say, I have a thing, come invest in it. And if you have a fund that is also set up with a regulation saying that people are going to be accredited, we can advertise, then you can just advertise like that and try to get that. For both funds and syndications, then there's the 506B, which means people don't have to be accredited, but it's up to me to make sure that they are educated about what the risk is going to be. And it's up to me to make sure it's a fit and not be taking advantage of people. So I interview people and I'm like, is there a chance that you will need this money within the next year or two for car repairs or medical expenses or emergencies? And if that's the case, do not give me your money. I need to make sure that people know this money is going to be tied up. Is that okay with you? Do you have enough other funds elsewhere that you could liquidate if you really needed to? And with those, I'm not allowed to just advertise to the public. I can only talk to people that I already know. So it's the same with a fund. Sometimes there's accredited, sometimes there's not accredited, and then there's also a CF, designation CF is crowdfunding, which does allow you to advertise. And I haven't studied how to set that one up very much. And then there's another one, A, I think. I'm not an expert on all of the different types of funds right now, but give me a year. Let's meet back again in a year.
Yeah, we can do that.
We'll talk more about the different types of funds. But when you want to invest with someone, you'll be a limited partner. The general partners are the people who are making the decisions and doing the work, acquiring the deals, disposing the deals, all of that, doing the asset management. Those are the general partners.
And then a limited partners contributing capital to receive.
And nothing else.
Kind of like a passive return?
Absolutely. Limited partners are 100% passive. They have no responsibilities, but they also have no real control. They don't get to vote on stuff. Right. In the project where we are putting you in the LLC as a capital partner, in that case, you're not a limited partner. You're an active partner in the LLC, and you will have a vote in 10 years when the guy wants to sell the house. We are going to meet and you're going to be there and we're going to say, these are the numbers. We think we should sell the house. And you can say like, I want to keep this up too. And we can discuss it. So
got it.
You're a very active partner in that deal, which is different from being a limited partner in these other deals. Active in the sense that you have voting rights and we will be conferring with you about decisions. Passive in that you don't really have any responsibilities to take care of the property or find the end buyer. like our role is to take care of that.
You
But
guys just hire a property management, or you just kind of
no,
manage it
no,
in-house?
we don't have a property manager. The end buyer owns the property.
No, you're right. You that makes perfect sense now that I think about it.
And I do often have people ask me, they're like, is this secured with a lien? And I'm like, there is no lien. You own the property. You're
Got it.
part of our company, and our company owns the property. So you're an active member in our company.
Okay, very neat.
So those
I
are
like
different. I keep mixing up I'm going back and forth between syndications and this other fractional ownership deal. But yeah.
a lot of good information there.
Oh, I was going to mention for 506B. So one thing I mentioned is I can't advertise 506B. So the project I have right now is 506B. And sometimes it is possible that during the raise, you can flip it. Like you could start 506C and then you could switch to 506B. Anyway, you can change your designation if you need to. But the point I was getting at is I have this amazing project right now, but I can't just like advertise to the world about
Let
it.
people know
But
about
if
it.
people already know me, we can talk about it. So one thing that I do offer is I'm like, get to know me now, because I'll have another one in a couple months. So I like to reach out to people, and I have a 506B like questionnaire where I want to get to know where you're at so that I can help you decide if this is a good deal for you. And then we have a call and we have a conversation, and then you're part of my 506 friendship, and I will be talking to you, every month about different things. And then eventually another 506B multifamily will come along, and then I'll invite you to invest.
Gotcha.
So I invite people to reach out to me, and let's at least connect. And maybe 5 or 6 months down the line, I'll have a really cool project and invite you to invest in it with me.
Well, where can people reach out to you to connect with you?
So I have a few choices. On Facebook, I'm Gina Weibel. On Instagram, I'm at G Weibel. And on LinkedIn, I'm there too.
Okay, I'm going to go ahead and put up your Instagram here on the screen, and
Yeah.
I'll add those other links into the YouTube description for when this is posted.
Maybe in 2025 will be the year that I start talking about real estate on my socials, because right now my socials, all I talk about is my broken arm and all the music that I'm not playing, and all the other things. I haven't really made it into a real estate page yet.
Not really
But
branded that way yet, huh?
I'm not branded yet, but a few people know who I am and what I'm up to. So I need to flip that script. Maybe is 18 months long enough that it's time I should flip the script? Probably. I don't know.
Yeah, probably not a bad idea. I mean, like, if people don't know you're there, how can they do business with you?
Right.
So,
I usually, yeah, I know. I haven't been using social media to meet people. I've been using other venues. So.
oh, fair enough. As before we end the episode today, I just wanted to ask you: do you have any recommendations for people that are just getting started on educational material, books, podcasts, etc., that they should check out in order to learn the things that they need to do to be safe when they're doing their investing?
Yes. Well, I am a big fan of Pace Morby's communities. So I joined other communities, and then I felt like they were introductory, and they covered, for example, Pace Morby has his Gator community. If you want to do lending of any kind or get involved in the money side more so than the deal finding side, then go be a Gator. And in Gator, he has Snappy Start and Newbie Nest, and the material in those like introductory prerequisite Zooms was comparable to the complete mentorship that I had been in before, which was a how to wholesale mentorship and how to do flips mentorship. And I was thinking, oh my gosh, this is just a free part of Gator, which is just a free making sure you're up to speed. And the education there was already completely everything that was in the other mentorship. So
yeah, personally, it's been
made me feel like I
transformative.
hadn't. What's that?
Personally, it's been transformative for me from joining Gator,
Right.
because that's why I started the podcast. That's why I've purchased a house, why I've invested in a crowd fund, all kinds of things. I did a private money loan. It all stemmed from the things that I learned in the Gator mentorship.
Yes, I agree. And then I joined the sub 2 community a few months later, and the level and the quality of communication is beyond what any other mentorship I've seen has got. And the connections and the people to work with has been amazing. So I've done 4 syndications, and one of them I found through um, a mentorship that I did that was the multifamily mindset. And that mentorship started out super rough. I joined in January of 2024 and I was not impressed. The 3-day class that they have is totally worthwhile. I recommend it to anyone. It cost $1,500 and they did a great job. And based on that, I was like, that was so good and so amazing. I'm going to join your mentorship. And then the mentorship was very bland. And I was like, there's no information here. They didn't have anything on capital raising, nothing.
Hmm.
And I was like, capital raising is one of the biggest parts of this. Like, acquiring a deal is important, capital raising is important, underwriting is important, but they had nothing on capital raising. So for about a year, I was just thinking I lost my money and it was a total waste of time. And then in November of 2024, they restructured their program and now they have a whole capital raising course. So I can't really give a review of it yet because they haven't rolled the whole thing out.
Kind of a work in progress, kind of a mentorship.
Yeah. So
Gotcha.
I would say that whole mentorship is still figuring out where they're going, but it's looking optimistic. So I can't necessarily give it a whole hearty thumbs up yet. But if you're interested in multifamily, the 3-day class is worthwhile.
Mm-hmm.
It's like $1,500 and they cover stuff. And I feel like with that, you could do a lot. And then I did not find a lot of people to work with using their network. And part of the problem there is that most mentorships, you pay a huge amount and you're in for a year, and then everybody leaves after a year because they don't want to pay that huge amount again.
Got it. Okay.
So while you're there for a year, everyone that you're interacting with is also in their first year of doing this type of thing. And so you're like, how are we going to work together if none of us
Know
are
what we're doing.
have any experience? Like, I'd prefer to join a team that has a little experience. Which is why Pace Morby's program is brilliant, because you pay once and then you get to be part of the community. And there's people there who've been doing it for 8 years, and I like working with them. So I
Yeah.
think there's a chance multifamily mindset might develop some kind of community that lasts longer. I don't know if they're going there yet. Nevertheless, there's like 20 different mentorships that teach multifamily how to get involved. And I would say don't feel like the first one that you hear about is the one you have to join. Go research all of them and ask other people who've been in them for reviews. And for me, if you're interested in capital raising, ask how much education is there about capital raising? Because what I'm finding out is, even though they tell you they'll teach you everything you need to know about multifamily, for some reason they don't include any education about capital raising.
Interesting.
But I
One
think
one
that
of my
goes.
business coaches, he says there's only 2 things you really need to own property in real estate, and that's money and deals. And so those are the 2 aspects that you need: is learn how to generate leads for sourcing deals, and then learn how to raise capital.
Right.
Um,
That's right. And along with raising capital, I'm going to reiterate that you have to learn how to underwrite. I know that they kind of separate those into different skills,
mm-hmm.
but you have to know how to underwrite, because otherwise, how do you know which deals to raise on?
Yeah.
You don't want to raise on a bad deal. And underwriting isn't just the deal, it's also the operator. You don't want to work with an operator who turns out to be flaky or something. So it's worthwhile to take the underwriting courses as well as the capital raising courses, even if you don't plan to underwrite 100 deals. One thing that's nice in the multifamily mindset now, for people who choose to focus on underwriting, part of their coursework is they have to underwrite 100 multifamily deals.
Okay.
So I like that, because you're going to have to underwrite 100 deals before you can start to see patterns of what's good, what's bad, what looks questionable. And I plan to do that. Maybe that'll be part of my 2025 as well.
There you go. Well, cool. Well, you've mentioned kind of what your goals are to get those 85 extra houses in 2025, which is pretty awesome. I look forward to seeing you build that. Have anything else you would like to leave with the audience before we end the episode today?
Yeah. Do the slow warm-ups. Take all the steps to do the thing before you do the deal, and put your safety gear in place. Put all of your documents in place and use the right TC and do all the safe things, which you guys, I had risk guards with me. I just didn't put them on. Because otherwise you're going to get hurt, and it's going to take you a very long time to grow back. It doesn't mean it'll kill you, but it'll take a long time and it'll be painful. So.
And then you'll learn those lessons the hard way when you could have learned them from someone else. Well, appreciate your time here on the show today, Gina. And I just want to let everyone know this has been the Pot of Gold podcast, where we talk about finances, wealth generation, and real estate investing. And thank you so much for tuning in.